Hey traders, Todd Gordon here with TradingAnalysis.com. This is for CNBC's Trading Nation. Traders, let's go to work in Netflix. I'm liking the daily chart here. Looks like we have a breakout happening here that's been in formation through the back half of 2017. So as you focus in here on this consolidation, just around the 200 region, this in the technical world, the technical methodology that I use, which is Elliott wave, this is going to consider this a fourth wave, which means we're going to have one more breakout that should target this zone of fib resistance right around the 250 mark. Now we are heading to earnings on January 22nd. I don't think we're going to get the full $45 move here in the next couple weeks, but let's begin to work on up towards that target resistance zone. So what I'd like to do is begin to establish a long position by selling puts. I'd like to sell a put spread rather than buying a call spread. Not a good idea to be long options into earnings because you're inevitably going to get that implied volatility crush post earnings, and that's going to hurt the value of both puts and calls. So I like to short puts heading into earnings. I want to contain my risk by selling a put nearby, but then buying a lower put, which is called a put credit spread. So the trade I'd like to do here is in the options that expire on January 26th. Again, earnings are the 22nd, so this will take us through. I'm gonna sell a put that's very close to the market here. I'm gonna sell the 205 put as we're currently trading 205.84. I'm gonna pair that up with a purchase of the 195 put. That effectively capture risk becomes a stop loss in a sense. So the difference between selling the 205 put, buying the 195 put will be a net credit to us of $3.90 or $390 per option spread you're trading. That will give you a max reward as the, that will give you a max risk as the platform will tell you here of $635 if the trade goes completely wrong and you hold this all the way into expiration, which we should not do. The design and purpose of this trade is to be out ahead of earnings, or if we have a comfortable profit margin heading into earnings, perhaps you can hold it and chance it, roll the dice a little bit. But if we show a good profit heading into earnings, we'll likely take that trade off the table and move on. So let's go ahead and see if we can get our $3.80 to 90 cents worth of credit, depending on where you're filled when you see this video. And that trade is now working. Back to the chart here, guys, as we zoom in. If the market were to break back below this breakout point here, just at about $200, let's take the trade off. Okay, so I'm going to put a stop loss in. If the underlying market gets back to $195, let's cut the trade. It's obviously not working and move on because we want this breakout level that we're focusing on to hold. This should be your newly formed support level. If not, let's get out and contain the risk. Otherwise, looks like we should be able to move on up to the 250 mark in the first half of 2018 in Netflix. For CNBC's Trading Nation, I'm Todd Gordon. Good luck on that trade in Netflix. Be sure to follow us at Trading Nation on Twitter for updates to this trade, as well as all the other markets that our traders are watching. And we'll see you guys in the next video update.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.